Welcome to this video for bank directors and trustees on interest rate risk. This video provides an overview of the key aspects of the interest rate risk, or IRR, management process.
We'll begin by discussing what interest rate risk is and the different forms it can take. We'll talk about the common types of measurement systems or models that banks use to measure their exposure to movements in interest rates. From there, we'll talk about some key assumptions that drive model results and why banks ensure those assumptions are reasonable.
We'll also discuss how board members can establish a comprehensive interest rate risk management framework. Finally, we'll address the importance of establishing an adequate internal control system, including an independent review process.
Interest rate risk is the risk that changes in interest rates can adversely affect a bank's earnings or capital. Virtually every bank, no matter the size or complexity, has repricing risk, yield curve risk, option risk, and basis risk. We'll discuss each of these, beginning with repricing risk.
Repricing risk arises from timing differences between rate changes or cash flows from assets, liabilities, and off-balance sheet instruments.
Let's illustrate this with an example. For simplicity, let's assume a bank has one asset and one liability. The asset is a 15-year fixed-rate mortgage priced off the 10-year Treasury rate, and it's funded by a 1-year time deposit priced off the 1-year Treasury rate. Today, the bank is earning a 3% spread.
Let's review what happens in year 2 if market rates rise 2%. The yield on the 15-year mortgage stays the same at 4%, but now the liability has repriced and the cost has increased from 1% to 3%. Resulting in a decline in the spread.
Yield curve risk arises from changes in the shape and slope of the yield curve as short and long-term rates move in non-parallel ways. To put it another way, yield curve risk is the risk from changes in the shape of the yield curve.
For illustration, in the first quarter of year 1, banks are able to borrow short at rates close to 1% and lend or invest at around 5% for longer-term loans and securities. The bank in this scenario is able to take advantage of the spread and earn about 4% by borrowing short and lending long. What is the risk associated with this scenario?
Let's say that over the next 2 years, the yield flattens. Short-term rates increase in year 2, while long-term rates decrease slightly. As a result, the spread between short and long-term rates narrows and bank margins begin to fall.
In year 3, the yield curve flattens even more as short-term rates increase further. This change essentially eliminates the interest rate spread.
Let's look at a simple balance sheet example to quantify the impact of changes in the shape of the yield curve. Here, the bank originates a 15-year mortgage that is priced off the 10-year Treasury rate and funds it with a liability that is priced off the 1-year Treasury rate. In period 1, the net interest spread is 5%. But what happens if the yield curve flattens?
In period 2, the bank originates a new mortgage and earns 6.5%, but funds that with a liability that now costs 4%. As a result, the spread on new production has declined to 2.5% because of the flattening of the yield curve.
Option risk occurs when others determine the repricing of a bank's assets or liabilities. Options can alter the timing of cash flows or rate changes, and option risk is the risk that embedded and explicit options present to an organization. It can adversely affect earnings by capping asset yields or increasing funding cost, and can affect the value of a bank's assets and liabilities.
Now, let's illustrate option risk in more detail. Here, we show a bank holding a 15-year fixed-rate mortgage. The bank has funded the 7% mortgage with a 3-year time deposit that costs 4%. In this example, the bank will earn 3%.
But what happens when general mortgage rates decline in period 2? Let's assume that interest rates decline by 2%. Our mortgage customer refinances or prepays their mortgage and is now paying 5% versus 7% in period 1. Assuming the bank is able to keep this customer It's now earning a much lower yield on the asset, while still paying the same rate for the time deposit. As a result, the spread in period 2 has declined from 3% to 1%.
Basis risk occurs when different indices do not move together. In other words, it's the risk that the rates a bank bases its asset and liability pricing upon will move in a way that could negatively impact earnings.
As an example, with basis risk, we have a commercial loan priced off the 3-month Treasury rate, funded by a Federal Home Loan Bank, or FHLB, borrowing priced off the 3-month rate from the FHLB index, resulting in a spread of 2.25%. It appears this bank is well matched because both indices are based on identical repricing frequencies. But what happens if these rates change disproportionately?
Here, the Federal Home Loan Bank rate increases 2%, but the 3-month Treasury rate only increases 1%, resulting in a decline in net interest income despite having a matched repricing frequency. Now that we've discussed the types of interest rate risk, let's talk about the typical short-term and long-term systems community banks use to measure these risks.
Income simulation models measure the effects of interest rate changes on net interest income and net income. Extended income simulations consider the long-term earnings perspective by measuring the impact of rate changes on income beyond 2 years. Economic value of equity, or EVE models, also provide a long-term view of interest rate risk by measuring the change in net present value of the assets, liabilities, and off-balance sheet items in different interest rate scenarios. GAAP models measure the maturity mismatch of a bank's balance sheet.
However, effective banks do not typically use a GAAP model as the primary analytical tool for assessing interest rate risk. The usefulness of a GAAP model is limited since it cannot truly measure the effects of embedded options, non-parallel yield curve shifts, or basis risk. But if properly calibrated, income simulation and EVE models can capture these additional types of interest rate risk.
The ability of any of these models to measure interest rate risk is highly dependent on appropriate assumptions and inputs. We'll discuss some critical assumptions later in this video.
First, let's talk about an income simulation model. Income simulations estimate cash flow from assets and liabilities over selected time periods to project future earnings performance under assumed interest rate scenarios. Here's a simplified example of how an income simulation model measures the change in income when rates change. The base case is simply an estimation of the bank's income based on the current balance sheet and contractual interest rates, assuming no market rate changes. In the scenario analysis, the model estimates the income based on the new market interest rate. In a plus 300 basis point movement, the rate on loans and municipal bonds did not increase because those assets are fixed rate and long-term. However, the rate on non-maturity deposits increased, but not by the full 300 basis points. It only increased 100 basis points. That's because of model assumptions, which we'll discuss in more detail in a few moments.
After calculating interest income and expense on the bank's earning assets and interest-bearing liabilities, the model estimates net interest income if market rates increase 300 basis points. The model performs these calculations for each scenario modeled. Typically, models also calculate the change in net interest income between the base case and each scenario. In our example, in a plus 300 basis point movement, net interest income is expected to decline 23%. Reports generated by the model can be used to monitor the bank's interest rate risk level and to evaluate whether the levels are consistent with the bank's policy risk limits.
Let's move on to economic value of equity, or EVE, which is the difference between the present value of assets and the present value of liabilities, and the value of applicable off-balance sheet items. How is this different than the book value?
Well, net present value is different because it considers the difference between book yield and market yield. Let's look at an example. Let's say the bank has a loan on the books earning the 5% current market rate. If market rates increase, the value of the loan will decrease, and the present value of the loan is less than the book value because the loan is earning 5% while newly originated comparable loans are earning more.
On the other side of the balance sheet, the bank has a time deposit paying the 1% current market rate. If market rates increase, the value decreases because the bank is paying less for time deposits than they would pay for a newly booked time deposit. This is a good thing for the bank because a decrease in the value of liabilities increases the economic value of equity.
Remember the formula. Present value of assets minus present value of liabilities equals economic value of equity. So, what is the net impact of the changes on both sides of the balance sheet?
Let's look at a sample EVE model report. The model calculates the bank's EVE in the current rate environment, which is the base case. To measure interest rate risk, we need to look at how the present values of assets and liabilities change in different rate environments. The change in EVE, or the potential risk exposure, occurs when asset values and liability values do not change by the same amount.
When rates increase, the present value of assets and liabilities decline. This is because the bank is now holding an asset earning less than the market rate and holding a liability paying less than the market rate, keeping in mind that a decline in liability values has a positive impact on EVE. In the plus 300 basis point movement, asset values decline more than liability values, causing a net decline in EVE. The opposite occurs in the negative 100 basis point movement. In this scenario, asset values and liability values both increased by $5 million, so there was no net change in EVE.
Comparing base EVE to shocked EVE provides a measurement of the level of interest rate risk exposure. In our example, economic value of equity declined from the base case of $90 million to $75 million in the plus 300 basis point scenario, a decline of about 17%. And as with income simulation results, EVE model results are assessed to more effectively monitor the interest rate risk level and evaluate whether the levels are consistent with the bank's policy risk limits.
We're frequently asked why a bank would choose to run both EVE and income simulation models.
As we've discussed, an EVE model's calculation of present value captures the cash flows and rate sensitivity of all assets and liabilities, while an income simulation only captures these attributes for the time period it measures.
Most community banks have long-term assets and liabilities with options, and income simulation models focus on short-term risk. A longer-term interest rate risk measurement, such as EVE, will allow management to assess how strategic decisions made today could impact the bank's financial position and earnings in the future.
Because the income simulation is performed for specific time periods, it allows banks to identify when the interest rate risk occurs, which the EVE can't do. Therefore, using a combination of both models provides banks with a more complete picture of the interest rate risk exposure.
One of the main benefits of using interest rate risk measurement systems is understanding the impact of low probability but high impact events. By knowing the impact, management can make contingency plans and take mitigating steps to protect earnings sustainability, and the board will be able to oversee those actions and determine their effectiveness.
Now that we've talked about the measurement systems that can be used, let's talk about some of the assumptions that are used within those measurement systems. Reasonable and realistic model assumptions are important for accurately measuring the interest rate risk position. We're going to discuss several assumptions, but focus on three critical ones: rate changes, deposit assumptions, and prepayment speeds, beginning with rate change assumptions.
The magnitude of rate changes modeled is critical to interest rate risk measurement. Looking over the last 60 years or so, there have been many periods when short-term rates changed significantly and relatively quickly. In about 1/3 of the years, the federal funds rate changed 200 basis points or more within a year. And in a 2-month period in early 1980, the federal funds rate rose 635 basis points.
This indicates that a 200 basis point rate scenario may not be sufficient to adequately assess a bank's interest rate risk exposure. So banks may want to consider scenarios involving a greater range of interest rate shocks. Some model scenarios include instantaneous rate shocks and prolonged rate changes. An instantaneous rate shock assumes the rate changes immediately, compared to a gradual ramp, which assumes the rate change occurs over time.
A key aspect of rate change assumptions is how rates will change for different maturities, since rate changes typically do not occur uniformly across maturities on a yield curve. The solid brown line depicts a yield curve in the first quarter of year 1. When rates rose in years 2 and 3, they rose much more dramatically for the shorter maturities than longer-term maturities. In fact, rates remained relatively unchanged for the 20 and 30-year maturities. In other words, the yield curve shift was not parallel. If there had been a parallel shift from year 1 to year 2 instead, the yield curve would look like what is depicted by the dotted brown line. Model scenarios also consider changes to the slope and to the shape of the yield curve to measure the exposure from non-parallel changes.
Next, we'll discuss deposit assumptions related to the measurement and value of a bank's deposit base. Non-maturity deposit assumptions can have a material impact on model results because they often represent a large portion of a community bank's balance sheet. These deposits are typically defined as demand deposit or checking accounts, savings deposits, and money market demand account deposits.
It's important for board members to be familiar with 3 primary non-maturity deposit assumptions: price sensitivity, which is commonly referred to as beta, decay rates, and average life. The price sensitivity assumption measures the degree to which the rate on a deposit will change when the market rate changes. In the earlier discussion on income simulation, the rate on the non-maturity deposits only changed 100 basis points in the plus 300 basis point shock because management assumed a beta of 33%.
It's important to understand the model's beta assumptions to ensure they are reasonable in both rising and falling rate environments. Depending on the current level of market rates and competitive factors, some banks may experience different betas in rising versus falling rate environments. Banks typically also see different betas for scenarios of different magnitudes. For instance, in a plus 400 basis points movement, a higher beta would be observed than in a plus 200 basis points movement.
Decay rate is the annual percentage of deposit runoff or attrition. The average life is the average time, expressed in years, deposits are expected to remain with the bank. These assumptions are typically based on an analysis of the bank's historical data, adjusted for qualitative factors, such as changes in competition, customer behavior, or the economy.
The last critical assumption we will discuss is estimated prepayments on loans and securities, particularly mortgage-related assets. Prepayment speed assumptions impact the average life of a mortgage pool and the timing of cash flows, which are key to income simulation and EVE modeling. In a negative 100 basis points movement, borrowers are more likely to refinance and prepayment speeds are higher than the stable scenario. As such, the weighted average life is shorter. Banks have to reinvest those cash flows at lower yields. This is called prepayment risk.
In rising rate scenarios, when borrowers have less incentive to refinance and prepay, prepayment speeds slow, causing the weighted average life to increase. This is called extension risk. The bank is left holding an asset that is earning a below-market yield. Because prepayment assumptions are important, understanding management's prepayment estimates is an important part of interest rate risk management. Are the assumptions internally generated or based on market proxies? Are they appropriately supported?
As we mentioned, there are many assumptions to consider when developing interest rate risk models. Other assumptions include embedded options, such as the ability for a customer to prepay a loan or terminate a time deposit before maturity, and account aggregation, or grouping similar items together and dissimilar items separately for modeling purposes. This is an important consideration because each asset or liability has unique characteristics that affect cash flows differently. Management may consider driver rates, which capture the relationship between market rates and the pricing of bank products within the model, and zero balance sheet growth or static modeling versus dynamic modeling, which anticipates growth or other changes.
Because of their importance, critical assumptions are typically documented and supported. In addition, a common practice is for management to report any changes to key assumptions and their impacts on model outputs to the board for review.
So once assumptions are established within the model, how does a bank determine how much influence an assumption has on model results? That's where sensitivity testing comes in. Sensitivity testing, or sensitivity analysis, is conducted to allow a bank to determine which assumptions have the most influence on model output.
Sensitivity analysis is performed by taking the original model report, that is, the one used for risk management purposes with original assumptions and scenarios, changing a single key assumption, rerunning the model, and reviewing the differences between the two results. By holding all other model variables and assumptions constant, management can determine both the extent to which an assumption influences model results and at what point that exposure becomes potentially excessive or breaches policy limits. The most effective approach is to perform this review separately for each key assumption.
This sensitivity analysis example shows net interest income results under multiple deposit beta assumptions. Even a small change in the beta assumption can have a material impact on net interest income results that the board may need to consider when reviewing the bank's risk management framework.
Now that we've covered what interest rate risk is and how it's measured, let's talk about the board's responsibilities in this area. These are addressed in Appendix A to Part 364 of the FDIC Rules and Regulations, the Interagency Guidelines Establishing Standards for Safety and Soundness. Appendix A lays out minimum standards that should be met in managing a financial institution. A bank should manage interest rate risk in a manner that is appropriate to the size and complexity of its assets and liabilities. The appendix also indicates that banks should periodically report their interest rate risk position to the board with adequate information for directors to assess the level of risk.
The board is responsible for the bank's affairs. This would include establishing policies to govern the interest rate risk management program and setting risk tolerances based on the monitoring program, earnings position, and capital levels. It means identifying lines of authority and management responsibilities for managing, monitoring, and reporting, and actively monitoring the position through regular review of model results.
Board members benefit from understanding the implications of IRR strategies the bank pursues, including the potential impact on market, liquidity, credit, and operating risks. The board can also benefit from establishing a solid internal control and independent review function.
While it's the board's responsibility to oversee the interest rate risk management process and monitor the position, management is responsible for managing the process as well as monitoring and controlling the position.
One of the key ways the board can fulfill its responsibilities regarding interest rate risk management is by overseeing the development of policies that govern this area. Policies translate the board's goals, objectives, and risk appetite into operating standards that can be understood by bank personnel and are consistent with the board's intent.
Policies typically specify risk limits for both earnings and economic value of equity exposures, document lines of authority and responsibilities, establish reporting standards and an independent review process, and identify the types of instruments and activities the bank may use to manage interest rate risk exposure. Note that if hedging strategies were used, policies would outline permissible strategies and relevant limits. Board members commonly ask, what are appropriate risk limits?
We can't answer that question because there is no single right answer. Boards consider various factors when determining the appropriate policy limits for their banks. Limits reflect the board's risk tolerance and serve to control interest rate risk. Directors can ask themselves, how much interest rate risk are we comfortable with? The board would consider the strength of earnings and capital and the complexity of the balance sheet, products, services, and activities.
The board can consider changes in the bank's risk profile and ensure that risk limits are revised to reflect those changes. For example, a bank that has higher risk assets or is experiencing asset quality problems might consider the increased pressure on capital from these factors. Capital levels that are exposed to higher risk balance sheet products from a credit perspective may not be able to withstand the same level of interest rate risk as banks with lower risk products. Having effective risk limits triggers appropriate action as identified in policies and ensures that management promptly addresses situations where positions exceed certain predetermined levels.
When the board establishes risk limits on net interest income, it could also consider the impact on the bank's bottom line. Developing limits relative to what is measured in the model may be helpful. A 20% change in net interest income is different from a 20% change in pre-tax return on average assets.
Let's review the impact on a hypothetical community bank's pre-tax earnings if net interest income were to decline by 5%, 10%, 15%, and 20%. In this example, pre-tax earnings would decline more than 60% through what may have been considered an acceptable degree of net interest income exposure at 20%.
Therefore, the board might consider net interest income limits in relation to the bottom line to determine whether risk limits are reasonable for their bank. Additionally, some banks engage in activities that result in rate-sensitive non-interest income, such as mortgage banking. The board may want to set net income limits to assist in the overall control of interest rate risk exposure consistent with the bank's risk profile. Now, let's talk about internal control and review. Effective banks have an appropriate internal control system that promotes reliable financial reporting and compliance with internal policies and relevant regulations.
The independent review process for interest rate risk management covers the adequacy of and compliance with the internal control system, the adequacy of the measurement system and assumptions, as well as the accuracy of data inputs. The review would also cover the validity of calculations and backtesting, which simply means comparing previous model projections to actual performance in order to assess the reasonableness of modeling. An independent review is periodically conducted to ensure the integrity, accuracy, and reasonableness of these areas and covers the entire interest rate risk management process. The scope of the independent review would be commensurate with the complexity of the bank. The board would receive a report detailing the results of the independent review.
These reports typically provide a summary of the bank's interest rate risk measurement methods and management practices, identify key assumptions, and assess the impact of those assumptions on the measured exposure. A strong internal control system, verified by independent review, helps ensure a more robust interest rate risk management process.
This video has highlighted the overall interest rate risk management process and the board's responsibilities in this area. There are several questions board members can ask to better understand the bank's interest rate risk profile and process. They include: what rate scenarios are most problematic given the bank's balance sheet structure? What are the key assumptions and how are they developed? Are any new products or initiatives planned that will impact the bank's interest rate risk profile? What strategies can be implemented to mitigate interest rate risk? Are assumptions, data inputs, and model results reliable, and does an independent review verify this reliability? Does the independent review process include backtesting and validation?
As we conclude, we'd like to remind you that the FDIC has additional videos and resources that can be found on the Banker Resource Center at www.fdic.gov. If you need additional information or have questions or comments, please contact your bank's case manager or email the FDIC at supervision@fdic.gov. Thank you for viewing this video. We hope you found it both useful and informative.